Well, let's switch over and talk about markets now. Investors have started off the year largely unfazed by tensions in Latin America, extending a 3-year bull run driven by demand for technology and AI-linked shares. From Market Insights, Gaurav Kashyap, Futures and Equities lead at Equiti Group, is with us. Good morning to you. Happy New Year.
Morning.
So is it going to be a happy new year for global stocks? We've had a couple of years now of bullish run. Last year, MSCI global indices ended the year up, about 20%. Can we get a repeat of that in 2026?
Good morning to you, Jumana. It has, in fact, been an amazing year for U.S. equities. It was a third consecutive year where equities outpaced growth by about 17%. This was formed in large part by a very, very strong earnings growth backbone. And the growth has been phenomenal. We'd hope to see that continue through 2026. If we look at these 3 years of data that I was talking about, in 2023, if we look at the total returns on the S&P, about 3/4 of it can be attributed to multiple expansion, whereas only 1/4 can be attributed to earnings growth. We move towards 2024. We're seeing that ratio even out a bit more, where 55% of the total return is attributed to earnings growth, while 45% is attributed to multiple expansion. And now we move to 2025, where more than 79% was attributed to earnings growth and 21% was attributed to multiple expansion. So as you can see, this bull run has been fueled by earnings, and we're really going to need to see that continue.
And obviously, you're talking specifically about the U.S., but at the top of the show, I highlighted that actually over the last couple of months, what we've seen is a massive outperformance out of Asia, specifically Asia tech stocks. I mean, last year was a good year for U.S., for Europe, for emerging markets, for all of them. But if you look at the outperformance the last couple of months, it has been led by Asia. Do you think that that's going to continue this year?
I think, yes, it should continue. Again, one of the key themes that we're watching for is U.S. Fed policy. Ultimately, we are expecting to see a dovish Fed in 2026, and this should not only help the U.S. prospects, but it will also filter into Asian prospects with a risk-on appetite fueling interest in Asia. We did see a rather dovish Federal Chair Powell in December. They did deliver a rate cut, and they have pretty much committed to another cut in the early parts of 2026. We would expect to, if we do see somewhere around 2 or 3 cuts throughout the rest of 2026, this would continue to prop up.
Who do you think is the front runner right now to replace Powell?
Well, Hassett, Warsh, and the other candidate, Waller. I would expect to see one of them, obviously, one of these successors to come through. But ultimately, Jumana, I think they all are favorable to the market. They all adopt, in a lot of their interviews, they've all come across very, very dovish towards interest rates. So it will still create a very favorable risk-on environment.
I remember, if I rewind back to exactly a year ago, around this time, I was having conversations with people, and people were really bulled up. The Trump administration had just come in or was just about to come in. And all these American executives were talking about growth and deregulation. And then obviously we had the tariff shock back in April. Markets rebounded from that. And I just wonder, this year, where is the negative shock going to come from? Because once again, I feel like people are quite bullish going into 2026. What do we need to be mindful of?
So I think the biggest headwind to 2026 will be sustaining this excellent level of growth that we've seen. Again, if we focus on the U.S., GDP growth peaked at about 4% in 2025. We really would need these numbers to continue at this level or higher in 2026. Assuming we're in a low growth environment, this could, if we start with private credit markets, if we look at private credit asset under management, this figure has grown from around 300 to about 1.7 trillion over the course of the past decade or so. This dwarfs the growth seen in traditional high-yielding or leveraged loan markets. A lot of these deals were negotiated in low interest rate environments at 0 or 1%, and now borrowers are facing rates that are about 500 to 700 basis points above the secured overnight financing rate. So while there's no headline rate default rate, we are noticing that restructurings are increasing and covenant resets are materially increasing. So this is something to watch out for, because those types of shocks are exacerbated all at once instead of being gradual. And this systemic risk could then, filter into private equity markets, where then you look at valuations being reset downwards.
Yeah.
Sponsors are not looking to inject further liquidity. So this is something to be mindful of. Of course, we are also entering into a big a political year in the U.S., midterm elections. Of course, the bipartisan rift in Washington has never been wider, and typically, as you'd be well aware, the volatility and the stock market moves are much higher in a midterm election year than a U.S. presidential election year.
Yeah, we can worry about that later in the year. Gaurav, really good to have you on. Thank you so much for coming on Horizons.
Thank you.
Gaurav Kashyap, Futures and Equities Lead at Equiti Group.